Welcome to the WTR Small Cap Spotlight podcast. I'm your host, Tim Gerdeman, Vice Chair and Co-founder and Chief Marketing Officer of Water Tower Research. In today's podcast episode, I have the pleasure of being joined by Dakota Semler, CEO of Xos, Inc., NASDAQ ticker symbol XOS. Also joining is my Water Tower Equity Research colleague, Eric Goldstein. Xos is an American commercial electric vehicle company focused on last mile delivery and medium duty fleet electrification. The company designs, manufactures, and sells battery electric step vans, Class 6 chassis cabs, and OEM powertrains, while also offering the Xos Hub, a mobile battery-based charging solution designed for fleets operating in areas without adequate grid infrastructure. The company accounts UPS and FedEx Ground among its anchor customers, has deployed over 1,000 vehicles and powertrains, and has delivered 3 consecutive quarters of positive operating and free cash flow. The company manufactures in Tennessee and is expanding into Class 8 through an importer-dealer partnership with Windrose Technologies' R700 electric tractor. Excuse me. Dakota and Eric, thanks for joining me today.
Morning.
Thanks for having me. Morning.
Sorry, I have a little cough bug here today. Dakota, let me start by asking you to tell our listeners about the company. Specifically, what does the company do? What customers do you serve? And importantly, what makes this business different from the many electric truck companies that did not survive the past few years?
Yeah, absolutely. Happy to provide more context. So, we are a manufacturer of medium and heavy duty commercial electric vehicles and powertrains, and we support those vehicles by providing infrastructure and solutions to help customers get those trucks on the road. We've really been very fortunate to have some of the most demanding, but also some of the largest fleets in the industry as Xos customers. And I would say key customers, companies like UPS, FedEx, which are very, very demanding from a fleet standpoint. They have been customers for several years now, and we continue to grow. And we're actually one of the largest vendors for electric vehicles for UPS, as well as for fleets like FedEx Ground and several others. So we've got a diversified customer base across a range of different last mile delivery fleets. And now, as we've started deploying that charging infrastructure product that you mentioned, the Xos Hub, our customer base is becoming even more diversified, selling into some of the leading autonomous vehicle companies, state transportation agencies, investor-owned utilities, and other municipalities and city and state governments. So really a whole slew of customers across the board. And I think one of the things that's made us unique over the years and led to so much commercial traction, but also our ability to weather some of the storms that we've experienced over the last few years, including the supply chain crisis, the new tariffs that were proposed and implemented subsequently last year, and all of the different tailwinds and headwinds that have hit our industry, is that we have consistently been focusing on creating customer value and building customer success. And I think that translates into our product in a variety of different ways. One is building the most reliable product on the road. If our reliability doesn't exceed what fleets are used to operating in their diesel or traditional gas fleets, then we don't sell more trucks. So we are obsessive about how we make our fleets more reliable and keep trucks up and running on the road. The other thing that I think is unique in this space is we bootstrap this business from day one. So we put our own money into it. We treat every dollar we spend and every dollar we invest into the platform as it's our own money. And I think that fiscal discipline has been really owned and kind of operated throughout the entire organization. So we have always operated from the standpoint that the business needs to be profitable in its own right. We shouldn't be dependent upon incentives, subsidies, grants, or other things that are accretive for the purchase or sale of our vehicles. We really need to build this business on its own merits, and that's led us to being able to launch the most competitive electric strip chassis in the market. Priced our vehicle under $100,000 this year, and then it's also led us to still building profitability into that platform, so we can still sell those vehicles profitably. As you know, a lot of these companies didn't have the engineering expertise, so the supply chain relationships to be able to sell those vehicles profitably. And I think that's really key to our ability to scale and grow this beyond just being a small, commercial vehicle manufacturer.
That's actually a really remarkable strategy you just articulated, very intelligent. And I would just congratulate you on getting such traction with household name companies that you mentioned at the start. And with that, I'll turn it over to Eric.
Okay, thanks, Tim. And thank you, Dakota, for joining us on the podcast today. And that was a very impressive and a really great introduction. So let's just get into a few more specific questions. So, Xos, you went public via SPAC right around August of 2021, right around the peak of the EV truck bubble, if you will. And a lot of your peers from that era are now gone and aren't in business any longer. So I guess, can you talk a little bit more about what Xos did differently to still be standing and frankly, still winning business from customers like UPS and FedEx?
Yeah, absolutely. So, one of the things we touched on briefly in the intro is really that how much fiscal discipline we have in our organization. And this it translates into different things, right? It can be how we invest into our CapEx and how we build out our manufacturing lines. It can be our relentless focus on VAV or cost reduction in the platform and partnering with suppliers and creating additional value and reducing costs for the components that go into our vehicles. But there's a number of different ways, and we have always operated under the principle we need to be profitable from day one. So if we're selling one truck or we're selling 1,000 trucks, those sales need to be profitable. I think key to that is wearing a lot of hats. As a small manufacturer, we're not the big three, and we need to recognize that. We have to have a lot of different responsibilities, and we're very fortunate to have a team that understands and shares that as well. So we take everything very seriously, and if you're on the service team or you're on the engineering team, you're not isolated in a silo. Customer success is everybody's responsibility. And so having a team that's willing to step in and rise to the occasion when customers need new solutions is a critical part of that. And the other thing is really just learning from building partnerships with customers. Most of these customers are recognize that we're a newer company, recognize that we haven't been around for 50 years. And in doing so, they really can appreciate that Xos is going to make mistakes. They're very tolerant of those mistakes, so long as our responsiveness and getting back to them and resolving those mistakes happens very quickly and happens at the pace of their business. And so we focus on service. We have an internal mantra in the company, which is technology sells the first truck, service and support sells the second. And that's allowed us to really win that customer business from companies like UPS and FedEx. We continue to invest in the product. I think one of the things that many manufacturers make the mistake of is that they don't invest in the product over time. They don't think about cost reduction or improving efficiency or improving functionality for the customers. We do that every day. We live it, we breathe it, and we implement it into the platforms that we're selling to those customers. And it's actually been the reason why we've created some of our new product lines, like our Xos Hub, which stemmed out of a specific customer need. They needed fast, portable charging infrastructure to be able to deploy our trucks. We came up with an idea and we subsequently implemented that idea into a prototype. We let them test it. And then we actually took that idea because we saw how relevant it was and how applicable it was to other customers. And we scaled it into full series production. So really, I think it comes from listening to your customers and relentlessly focusing on keeping them happy.
Okay, great. Thank you. So let's talk about the business in a little bit more detail as it exists today. Xos has clearly evolved beyond just a trucking company, as you've been articulating. You've got the core step van and chassis business. You're also making powertrains for OEMs like Bluebird, and you have the Xos Hub mobile charging business. So, how do you think about the relative growth trajectories of each one of those businesses? And which one excites you the most over the next 3 years?
Yeah, I think it's no secret when we're talking about the truck business, it has faced headwinds in the last 12 months or so since the administration change. The regulatory environment has shifted, requiring less aggressive adoption. And so a lot of fleets have continued to purchase vehicles, but they've slowed their rate of replacement of existing vehicles. The coincidental thing, or I guess the ironic thing that's happened in the last 2 months or so, is since this energy crisis has unfolded, the total cost of ownership benefits of electric vehicles have presented themselves even more clearly. And so while the regulatory shifts over the last year and a half or so were slowing down the growth rate of the industry, that has come kind of roaring back with the demands for finding sustainable priced fuel sources. And that's where EVs really shine. Because if you think about how you charge your electric vehicle, you're buying electricity from the grid, which is generally regulated pricing over an extended period of time. So it gives fleets the upper hand that are deploying electric vehicles, that they aren't subject right now to $6, $7 a gallon diesel that you're seeing all across the country. And when we talk about that business, we expect it to continue to grow. We've built relationships that take, I joke, but sometimes we say these relationships take a decade to really come into fruition. And we have some fleet customers we've been working with for 7 or 8 years that are now going from ordering 1 or 2 trucks in the early days to ordering hundreds of trucks every year. And those are companies like UPS and FedEx that continue to see the value from the total cost of ownership savings. So that business will continue to grow over time. Our two new businesses, I'll just touch on those briefly, were stemmed out of customer needs and opportunities that we saw in the industry, particularly the hub charging business, the powertrain charging business. What you'll see is those are on very aggressive growth rates. And as we released in our Q1 earnings call, we saw tremendous growth in both those segments. And they could even get to the point where they might even exceed the size of the truck business overall. I don't think that will happen this year, but the demand for those products has continued to increase. And so in the coming years, we expect those businesses to grow at double digits and continue to be very cash flow positive and high margin segments where there's a lot of stickiness because of the uniqueness of our products, but also the way they're integrated into, subsequent end products, particularly in the case of the powertrains.
Okay, great. So let's take a look at the UPS and FedEx relationships in a little bit more detail. You received your largest order, I believe, from one single customer, 193 units from UPS. And you described Xos as primarily an electric vehicle vendor for UPS and the FedEx ground last mile delivery fleets. So how did you earn that level of trust from two of the largest fleet operators in the country? And what does that relationship look like going forward?
Yeah, I think it's pretty simple, but do what you say and say what you do. And so I think it's for us, we clearly articulate to the customer what we expect to deliver, starting back 8, 9 years ago, or 7 or 8 years ago when we started building the relationships with these customers. And as we continued investing in the product, improving the reliability, these fleets got confidence that we were going to be around to service these vehicles, support them. So when they're in their fleet 10, 15 years later, they won't be scrambling for parts or for service support, which is a critical part of adopting any new technology. You want to make sure that it's going to be supported over the entire lifespan of that product. And so building that confidence, and I think this speaks to our service team and our service network. We built out a nationwide service network to be able to support our vehicles. So we have brick and mortar locations in the West Coast, in Texas, and in the East Coast. And then we also have what we call traveling doctors. So these are folks that cover a broader region where we might not have as high of a density of vehicles. And they will support those vehicles with third-party partners that have facilities where we can do work on trucks. And really that maintenance organization is key to getting trucks turned around back on the road so that customers can feel confident in the vehicle. Because the reality is all commercial vehicles break down. All of them need service, either preventative maintenance or unplanned maintenance. It's a question of how quickly that truck is back up and running. So we spent a lot of time, a lot of capital in building out that service network. And I think that's one of the key attributes that customers really appreciate. The other thing I touched on, which is so important, is driving the total cost of ownership value for these customers. The single biggest investment these customers are making is the acquisition cost of the vehicle, which electric vehicles are still more expensive than diesel trucks. It's not a secret. We don't try to hide that or anything. But the closer we can get to parity on that acquisition cost, the more competitive we become, because then you're seeing the savings from the fueling costs and the savings from the maintenance costs accrue to their bottom line. And so we really try to drive value and drive costs out of that so that these customers can go to their CFOs and say, hey, this is the best option. It's not just more sustainable. It's not just reducing our emissions, reducing our carbon footprint. This is the actual best financial option.
So just digging in a little bit more on the FedEx ground routes. I mean, the electric truck seems like the perfect solution for those FedEx ground routes. Can you talk about how many trucks you have operating on their network now? And especially given the recent rise in gas and diesel prices, like you mentioned, have you seen an acceleration in interest?
Yeah, we have a bit under 1,000 vehicles within our FedEx Ground ISP fleets. The demand, as I mentioned before, has grown significantly for trucks since this energy crisis has come about. And I think one of the things we're seeing is fleets now realize any kind of gaseous, petroleum-based fuels are volatile. They will always be volatile. There may be points of price stability over, a long period of time, but they're always going to be subject to geopolitical factors, to hedging, to speculative forces in the market. Whereas energy prices on the electric grid or renewable energy that you're generating on site don't have that same level of volatility. And so the price predictability is one of the most valuable things because it can create business certainty for a lot of these fleets. So we've definitely seen an increased interest. A lot of that's ways work. A lot of that interest is working its way through our pipeline. So customers with renewed interest are now signing sales orders, speccing trucks, getting them ready for production. So we haven't delivered a lot of trucks in response to the energy crisis, but we do anticipate that we'll be delivering more trucks towards the end of the year purely because of the fuel cost increase.
That's great. So let's turn to your partnership with Bluebird. So you shipped your first production powertrain to Bluebird for both their school bus and commercial chassis platform. The school bus market is enormous and seems underserved by electrification today. So how big an opportunity is this? And is Bluebird the template for other potential OEM powertrain partnerships?
Yeah, it's a great question. And I love this application because it is truly one of the most ideal applications for zero emissions vehicles. When you think about the use case of a typical school bus, they go out early morning, they drive for perhaps 2 hours, they come back to the depot, they sit all day long, not doing anything, and then they go out for another 2 to 3 hours at the end of the day. So very, very limited use case where the passengers on the vehicles are obviously one of the most sensitive parts of our population. It's kids. So there's a clear need to reduce emissions, to make the air around school buses cleaner for the kids who are riding them. But beyond that, just the actual use case of how infrequently they're driven and the amount of mileage that they're driven per day makes them ideal for electrification. And one thing that's really emerged recently, and we'll touch on this a little bit, but is the demand for V to G, which stands for vehicle to grid. So those school buses, when they're actually back at the depot during the day, can become a grid resource. A lot of people talk about electric vehicles and how they're a drain or an impact on the grid, a negative impact. But the reality is, when you take that much energy storage and you connect it to the grid, it can actually become an asset. So during the day, you can discharge where there's excess energy generated from renewables or conventional fuel forms. And then when there's peak demands towards the evenings, when that school bus is coming back from its drop-off route, you can actually use that as an asset to be able to feed energy back to the grid via those V2G platforms. So we actually delivered some of our first V2G buses to Bluebird. We think it's an incredible opportunity in a market that's growing, and we're very fortunate to have that partnership with Bluebird because they're one of the leading bus providers in the alt fuel space. They deliver more propane buses, more electric buses than any other bus OEM in the US. So we feel it's a big testament to our powertrain that they want to work with us and partner with us on one of their critical components for their alt fuel segment.
That's great. So let's just dig into that just a little bit more. So you've been talking about the vehicle to grid, and so the school buses are sitting idle potentially for 6 to 8 hours a day. So this could be a transformative economically for people that are operating those fleets. So how are you positioning the vehicle to grid as a selling tool, and how does the revenue model actually work for the customer?
Yeah, so we in this case we're a tier one supplier to our school bus customers. So they are obviously marketing the product to the end user fleets. But the real value becomes taking a conventional asset that's used for one thing and now being able to use it for two different things or two different revenue sources. So V2G, the energy value that you can generate off a V2G asset varies depending upon which utility market and which utility jurisdiction you're in and how those programs are monetized. It can be from things like demand shedding or peak demand shedding. It can be from pure like actual V2G where you're sending power back into the grid. And every utility has a slightly different way of compensating you for that. It can be per kilowatt hour, or it can just be for resource adequacy, based upon the total number of kilowatt hours you have available at any given time. And really, that's up to the customer, depending upon where they're deploying these buses. It's never going to equate to the revenue streams or the revenue, the cost avoidance that you're generating as a school bus fleet. But those incremental sources of revenue can often offset the incremental capital cost of the vehicle or any investments you're making into charging infrastructure, which is huge as we're deploying more vehicles because it makes us, again, more competitive with diesel and makes the total cost of ownership more compelling.
That's great. So let's take a look at the Xos Hub mobile charging platform. So your next generation hub now comes in 210, 420, and 630 kilowatt hour configurations with entry prices starting around $150,000. And hub units have now charged gigawatt hours of energy in the aggregate across thousands of cycles. So who is the hub customer, and how does mobile charging solve a problem that the fixed infrastructure simply can't?
Yeah. So we like to think we're not we don't know what we don't know. And when we launched this product, it was really just to support our customer fleets and help them get charging deployed faster so we could sell more trucks. And we announced the product a few years ago, and we received a ton of interest from customers that we had never even considered. So now the majority of customers who are buying Xos Hubs don't even buy our trucks today. And that's autonomous rideshare companies, that's state transportation agencies. I like to talk about one of our bigger customers, which is Caltrans, the state transportation agency in California. They've deployed hundreds of electric vehicles across their fleet, and they've focused on really accelerating their electrification, but charging infrastructure hasn't been able to keep up. So they needed a tool to be able to charge these vehicles. They were taking delivery of trucks that they couldn't even charge yet. So we delivered a number of units to them. They're in use all across the state, and it's become a rapid way that they can scale their electrification efforts. We also sell to a number of other use cases. One of the best ones is investor-owned utilities or municipal utilities. So if you think about electric vehicles, they rely on the grid for charging power. But when there are things like natural disasters, that grid can go down. And so these utilities tend to have to provide backup services or resiliency services in the event the grid goes down. So we've sold a number to large investor-owned utilities like Florida Power and Light, Tampa Electric, Duke Energy, Xcel Energy, LADWP, and a number of other municipal and IOU utilities. So that's a demand for, when a hurricane's coming or a wildfire's coming and they need to provide charging, they'll roll one of these out into the field, expand their existing DC fast charging infrastructure, or just provide it unplugged for anybody, any of their ratepayers to come and use for free charging. So it's become a great resource for that. And then the last use case is really kind of unique, but I should say it's not unique, but it is something that hasn't really been addressed before, which is we have a lot of tenants or a lot of customers that are tenants of buildings they don't actually own. So their lease might be expiring in 3-4 years, and they don't want to invest hundreds of thousands of dollars or millions of dollars in CapEx into a facility that they're going to move out of. The Xos Hub allows them to put chargers in, support your fleet, roll out your trucks, and then when your lease is expired, you roll it out and move it to your next facility. So it allows you a greater cost flexibility without putting CapEx that's sunk into the ground. And that flexibility is something that's very valuable to a lot of these fleets. We've also announced or started to launch our next platform, which is an iteration on the Xos Hub, which has even broader use cases and applications. And that's something we're very excited about because it begins to straddle line, not just for mobile charging, but also for fixed power demands. So excited to be launching that into production this year. And I think we've got a lot more, an entirely new segment of customers that we haven't even addressed or reached with that product.
Okay, super impressive. Let's take a look at Winrose. So you guys recently signed on as an importer, dealer, and aftermarket service provider for Winrose Technologies R7 Class 8 electric tractor in North America. And I believe there's some discussion about potentially assembling some of their trucks at your facility in Tennessee. This would seem like a big strategic pivot for your company towards Class 8. So how do you think about managing a complex import and service model for a third-party product alongside your own manufacturing?
Yeah, so some people aren't aware of this, but we actually started the company focused on the Class 8 market. And the reason for that is I actually grew up in a family business and worked in a family business when I was a teenager, which was my dad's trucking fleet. And we had a couple hundred diesel trucks here in California and lots of different kinds of road maintenance equipment. And that's where I first learned about all the challenges that this industry was facing with the reliability of diesel vehicles and the new emission systems that were being introduced. So we actually got our start, or I got my start in Class 8 vehicles. When we started the company about 10 years ago, we started by building a Class 8 electric prototype. And we took it around the country. We visited companies like FedEx and Pepsi and all these fleets, and we asked them what they were looking for in an electric truck. And it was an incredibly insightful visit with those customers because they said, Class 8 electric is interesting. It's going to happen. It's a matter of time. The infrastructure isn't here yet. But where we are really interested in focusing is on the last mile delivery vehicles. And that was when we made a decision to strategically pivot to our medium duty vehicle platform that we have on the road today, now, thousands of vehicles, and continues to be our core product line. But we always felt that Class 8 was interesting, just needed some maturation and the availability of charging infrastructure to be able to support these larger battery vehicles. So we started, and actually we're going to reintroduce a Class 8 product a few years ago, and we realized that charging infrastructure still hadn't come along quite yet. But now it really has materialized. There's several companies that are providing public charging infrastructure. And I think that's also been validated by Tesla coming into the space and launching production of their semi. So we now think the industry is mature and the industry is ready. And we were thinking and evaluating on whether we build our own product or what else we could do to participate in this space. And we have been connected with Winrose. We knew a number of their team members from previous roles that they'd had and some of our suppliers. And we realized they built one of the most competitive electric trucks on the market. There's really nothing that's coming out of the legacy manufacturers or any other OEM that truly competes with the Tesla Semi, and this product does. And so we felt that we could help them with their distribution and service rollout. That's something we've learned over the last 10 years of supporting trucks and supporting these large fleets is the traditional legacy dealer kind of model doesn't support electric truck distribution like it should. Most legacy diesel dealers, they're not used to the longer sales cycle. They don't have the familiarity and understanding of deploying charging infrastructure. They generally prioritize their legacy diesel brands over their new, electric vehicle alternatives. So we've had to directly distribute our products to our end user customers. And we felt that we could support Winrose and utilizing our brick and mortar kind of footprint and our service technician team and all of our service knowledge to be able to help scale their products across the country. And so that's how this partnership really evolved and materialized. And I think we've only been doing this for the last few months, and the amount of interest that exists is incredible, like beyond what we anticipated. But really, I think this is going to be a growing segment for us in an area where we're going to continue to see the same level of profitability and the same level of growth potential that we see for our other two newer product segments, like the Xos Hub and the Powertrain division.
Wow. Okay, that's great. So let's just turn back to medium duty just for a minute here. So you recently launched a medium duty electric chassis at $99,000, and now you've got over 1,000 vehicles and powertrains deployed with customers like we've been talking about, UPS and FedEx, Cintas and Loomis. So breaking the $100,000 barrier seems psychologically important. Does that bring the price point to a level that will start to attract a new segment of fleet buyers for you who were previously sitting on the sidelines?
Yeah, it's a very, very pointed and good question. And I think the answer to your question is yes. Most of our sales to this up to this point have been in states where electricity costs are high or incentives exist to help bring down the acquisition cost of the vehicle, or there's just a very clear ROI from day one to be able to deploy electric vehicles. But there are a lot of markets, more rural markets, smaller cities where we haven't seen as big a penetration of our products. And that becomes the acquisition cost of the vehicles, fuel costs being lower, and being able to price the chassis at this price level opens us up to those newer markets. We're not as dependent upon incentives. It scales into smaller fleets that don't necessarily have that incremental capital to invest up front. So it definitely opens that up. The other thing it does for our large fleet customers is now they can really justify scaling into the hundreds, and hopefully one day, we'll receive orders into the thousands of units. But there are customers that easily purchase at that level on an annual basis. And going back and being able to say this is a 20% price premium or a 15% price premium over your traditional ICE vehicles is much more compelling than saying this is a 50% price premium. And it makes the TCO curve really a lot quicker, where you can be saving money on your electric vehicles without any incentives or subsidies in the first 3 years of operating your truck.
Okay, makes perfect sense. So, what all these great things are leading to is the fact that your financial performance has definitely been improving recently. So, you closed 2025 with 14 million in cash, which was up quite a bit from year-end 2024, and you've delivered 3 consecutive quarters of positive operating and free cash flow. So, for a company that came out of the SPAC era where companies were burning, cash, that seems like a really meaningful inflection. So, what's driving the cash flow, and how sustainable is
We cut our office supply budget. I'm just kidding.
it?
We've invested in areas of the business that really improve our operating profitability. So a good example of this is how do we think about automating things that we're going to continue to do, and for anything that isn't a core part of our value prop, like our engineering, like our supply chain, how can we work with partners to bring that cost down, or maybe, supplement that service or that thing that needs to be done with external partners. So we've restructured the organization, brought OpEx down year over year pretty significantly. Um, and now everything that we invest, we comb through with a fine-tooth comb. So investing into the platform, launching new products, new iterations, UL certifications, all of these things that are important requirements for the product, we make sure that we're going to market, we're doing it in the most competitive and most economically competitive way. Um, but I think the bottom line here is you can cut, cut, cut. That doesn't cut you to profitability. You need to still build a profitable product. And so where a lot of the value has been derived from is in setting out long-term pricing strategy and revising that pricing strategy on a biannual basis. So we look at our pricing twice a year and make sure that we're continuing to price things profitably, and then collaborating with our suppliers. Oftentimes there's this dynamic or this perception that you're at odds with your suppliers and it's a competitive negotiation. You're always trying to get them down on price. But if you take a different approach, and we learned this from one of my mentors, who's also one of our board members and was the former CFO of Caterpillar, Ed Rapp. If you take the approach of treating your suppliers as your partner and sharing with them what your goals are, what your targets are, and ideas of maybe how to achieve them, they become a lot more open-minded, right? And they can kind of put their guard down and say, hey, well, maybe if we do this thing, or maybe if we change this or tweak this a little bit, we can take a little bit of cost out on our side too. And that collaborative approach towards reducing pricing and reducing cost of our components has yielded a ton of fruit. And so we're really excited about that because we can go back to our suppliers. We can still allow them to be profitable, right? We're not hammering them on their margins while also reducing our cost overall. And that's what's led to this. I think the other thing that I can't take credit for, and is something that's industry wide, is that the scale and the growth of our industry as a whole has expanded significantly, exponentially. And so when you take products that are less than 1% of the overall market share and you expand them to 2%, you're doubling in size. We're still not at the same scale and level of internal combustion engine supply chains, but that cost, the ability for us to drive cost out when we increase scale twofold or threefold year over year as an industry is tremendous. So we've also benefited from large OEMs and large battery suppliers and electronic suppliers making investments in their plants and their lines and being able to reduce their costs too. That has nothing to do with Xos's efforts, but a lot of the side effects are we get some of those cost savings passed on to us because the industry, is growing so significantly year over year.
Okay, great. So just final question. Can you give us the roadmap for 2026 and beyond? So we've talked about a lot of great things today, all the great products you guys are producing, all the partnerships you have, the fact that you've been cash flow positive. So what do shareholders have to look forward to that we haven't covered yet?
Yeah, it's a important question, I think, for shareholders and investors to be aware of. And I might be repeating myself here if you listen to our recent earnings call, but we focus on three primary things: growth, margins, and liquidity. And we focus on improving those quarter after quarter, year after year. That doesn't mean every quarter we're going to be able to deliver growth in every one of those segments, but we are certainly shooting for it and we're striving for it. And so what that means, we try to expand and grow every one of our business units, and grow our customer or recurring customer sales. So we go back to a customer and try to increase those orders with those individual customers year over year. That drives top line growth, right? And so overall, we want to continue to grow each of those segments. And a big part of that is revenue diversification. It's not just relying on a single customer or a single product segment to drive revenue. We now have three separate business units, and we have key customers across all of those business units. So we want to get to the point where no customer in any period is greater than a 10% concentration of our revenue mix. And we're still a little ways away from that, but we think we can deliver that in the years to come. The next thing is margins. And I touched on this a lot, how we've done cost savings, how we've reduced OpEx, how we've focused on those supplier partnerships to drive better unit economics and on our product sales. And we'll continue that effort with our supply chain and our engineering teams focusing on that pretty obsessively. And then the last thing is liquidity. And this is any company in this space and in other sectors is focusing on how to build up a more robust balance sheet. And the best way to do that is by selling more products and selling more profitable products. So the more we can do to scale our sales, scale our revenue, we want to do that. Our industry as a whole has been heavily impacted. And so market caps and overall valuations of the company are lower than they ever have been. So fundraising via dilutive fundraising methods is not the right use of capital at the moment. But we do think that as investors see our financial discipline, as they see the growth in the industry and the different product segments that we've been launching over the past few years, I think that market demand and market interest from investors will return. And there's other ways to improve liquidity and to build a really robust balance sheet. But I think the resounding point that I'd make is that focus on growth, margins, and liquidity remains top of mind for us. So everything we do in what we're engineering, what we're developing, what we're bringing to market is focused on improving those three things. And we believe if you focus on those three things, the market will return, investors will return, and people will see the value of the company as we see it internally.
That makes perfect sense. And so, Dakota, thank you very much for your time today. Thank you for walking us through the story. There's obviously a lot of great stuff happening at your company. And now, Tim, back to you.
Thanks, Eric, for those very targeted questions. And to you, Dakota, thanks for really insightful answers. I have to say, as just kind of a non-EV guy, congratulations on not only surviving the EV roller coaster, but actually thriving during that period. So it sounds like you've really got some traction going into the future.
Thank you. Yeah, I appreciate you both making the time and for the solid questions, and looking forward to continuing to keep our investors updated and keep obviously your subscribers updated as well.
Thank you for listening, and don't forget to subscribe, as well as visiting www.watertowerresearch.com to stay up to speed on the company's small cap written research reports, podcasts, fireside chats, industry specific symposiums, and conference schedules. We will see you next time for another edition of the WTR Small Cap Spotlight podcast. Finally, a special thanks to the producer and editor of the podcast, Krista Fitzpatrick.